Welcome. I'm Tim Coughlin with Gay Truscott, and we are pleased to bring you our video presentation of Edgemoor Investment Advisors' fourth quarter 2022 report. Our agenda is to review the fourth quarter and full year of 2022 market performance, discuss inflation and interest rates, contrast prospects for recession or slow session, provide our outlook for 2023 with portfolio actions, and analyze a couple of selected securities. We begin with Gay for her presentation of current and future market and economic conditions. Gay?
Thank you, Tim. Most investors were happy to see 2022 come to an end, as nearly every segment of the financial markets posted losses for the year. But as all long-term investors know, markets do always recover from downturns to reach new highs over a full market cycle, however long or short that might be. So let's review the 2022 results. The S&P 500 index posted a negative total return for the year of 18.1%, just shy of bear market territory, defined as a decline of 20% or more, where it had spent much of the year. A 7.6% gain in the fourth quarter brought some relief, but stocks still posted their worst year since 2008. The tech-heavy NASDAQ fared even worse, down 33.1% for the year, as the collapse of many high-flying technology stocks like Tesla contributed to its bleak performance. Bonds had their worst year in history, with the Bloomberg Barclays Aggregate Bond Index posting a negative 13% total return for the year. To put that in context, prior year losses going back to 1976 had never exceeded negative 2% for the bond index. What this has meant for investors is that the traditional role of bonds and other income investments as a buffer to more volatile equities did not hold up, deepening the pain of balanced portfolios. Let me add that global diversification didn't help investors either, as both European and emerging markets indices experienced double-digit losses. But in perhaps the most spectacular crash of the year, cryptocurrencies spent most of the year in severe decline, capped off by the collapse of crypto trading platform FTX in November. The largest cryptocurrency, Bitcoin, lost over $550 billion in market value as its price sank 65%. All of this market volatility was in large part a result of the actions of the Federal Reserve. The Fed increased short-term interest rates 7 times last year in an effort to dampen the highest inflation rate in decades. The result was a jump in the Fed funds target range from near zero in January to 4.25% to 4.5% by year end. This was the fastest pace of rate increases by the Fed since the 1980s. The good news is that the worst of the rate hikes is likely behind us. Looking ahead, the Fed is expected to slow its pace of rate increases this year, and Tim will talk more about this in his section on treasuries. This brings us to the question, are we facing a recession or slow session in 2023? A recent Wall Street Journal survey indicated that economists place roughly 65% odds on the U.S. economy slowing enough to fall into some level of recession in 2023. But the depth and length of a potential recession remains up for debate. As seen in this chart of economic recessions going back to 1948, where sessions are represented by the gray bars, sharp increases in unemployment, represented by the blue line, have historically been associated with recessions, and you can see they are almost perfectly correlated. But in the US today, the labor market remains quite strong. As seen here, the unemployment rate remains near its historical low point of the last several years. Specifically in December, unemployment edged down to 3.5%, while wages grew 4.6% year over year, both signs of a robust labor market. As a result, some economists believe that 2023 might not bring a full-blown recession at all, but rather a slow session or a period of less than 1% GDP growth in each of the next 4 quarters. They point again to the strong labor market, healthy consumer and corporate balance sheets, and a well-capitalized financial system as reasons why the U.S. economy could avoid a significant economic contraction this year. Another bright spot in the U.S. economy is declining inflation. The Consumer Price Index, or CPI, which is the broadest measure of inflation, hit a high point of 9.1% in June of 2022, as seen in the middle bar of this chart. It has since declined steadily to its latest reading of 6.5% in December, which was the smallest 12-month increase in a year. One factor in the slowdown of inflation has been the sharp declines in energy prices since the summer. The price of West Texas crude peaked at $117 per barrel in May and has since fallen back to roughly $80 as of mid-January. Excluding the volatile food and energy prices, the core CPI is expected to settle back in a range of 3 to 4% by the end of 2023 from 5.7% in December. That would be good news for consumers and the economy. Given all these factors, our outlook for the markets includes continuing volatility, at least in the first half of this year, moderating inflation and interest rates, potentially slowing corporate earnings, and continuing geopolitical risks worldwide, particularly in Ukraine and China. However, we believe a sustained market recovery could occur in the latter half of the year if the Fed signals an end to its aggressive rate tightening stance. Our longer-term outlook remains positive as stock valuations are at more reasonable levels than they have been in several years. The forward 12-month price-earnings ratio for the S&P 500 currently stands at 17.3 times, below the 5-year average of 18.3 times, and well below the 23 times valuation at the beginning of 2022. We believe the lower valuation starting point should translate into better compounded returns for investors over the next 2 to 5 years. Now I will turn it back over to Tim for a discussion of the Treasury markets and another selected security we are currently buying.
Thank you, Gay. Gay has referred to our outlook for 2023. In the meantime, times are uncertain, and the largest investment we are currently making is in ultra-safe Treasury bills. These are short-term U.S. Treasury obligations combining the highest credit-rated investments in the world, attractive interest rates exceeding 4.5%, and ultra-short maturities for protection from market price fluctuation. The Fed has raised interest rates 7 times during 2022, bringing the federal funds rate to a targeted range of 4.25% to 4.5% at year-end, from near zero in January. The first hike was announced in March, increasing the federal funds rate by 25 basis points, followed by a 50 basis point increase in May. From June through November, the Fed executed 4 75 basis point increases, and in December, the Fed implemented a final hike for the year of 50 basis points. The surge in short-term interest rates has generated very attractive opportunities in the fixed income universe. For the first time in years, cash and short-term bonds provide a meaningful return. As a result, in October, we started buying Treasury securities with maturities ranging from 3 months to 1 year, with interest yields between 4.61% and 4.78%. In addition to very attractive yields, these bonds, backed by the full faith and credit of the U.S. government, carry little or no risk. After the multiple rate hikes in 2022, the Fed will likely slow its rate increases during 2023. The Fed's next announcement will come on February 1st, and the current consensus is calling for a 25 basis point increase. The market believes the federal funds rate will end 2023 at approximately 5%. We will continue to analyze the yield curve and purchase bonds that we think have the best rate of return potential. As Gay mentioned, stock prices have become more reasonably priced, and we believe should offer the opportunity for better returns in future years. We think many sectors of the stock market are undervalued and offer attractive long-term return potential. Once we see sign of the Fed pulling back from its aggressive rate tightening, and that economic growth and corporate profits have stabilized, we will resume deploying more cash in long-term equities. Meanwhile, in addition to purchasing Treasury bills in this currently uncertain market situation, one stock we are purchasing is General Dynamics Corporation, which we think is a timely purchase with strong demand for its military defense equipment and corporate jets. Virginia-based General Dynamics is the world's 4th largest defense contractor and the 2nd largest manufacturer of corporate jets. The company operates in 4 primary business lines: aerospace, combat systems, marine systems, and technologies. The company derives approximately 70% of its revenues from the U.S. government, 10% from foreign governments, and the remaining 20% from commercial customers. General Dynamics' well-diversified business mix and entrenched product offerings are the source of the company's leading market positions and wide economic moat. The company ended the third quarter of 2022 with an order backlog of $88.8 billion, equivalent to more than 2 years of revenue, which provides a high degree of visibility into future years' sales. The aerospace segment, which is predominantly composed of Gulfstream jets, enjoys a commanding position in the high-end business jet market and provides diversification from defense spending. Sales activity recovered quickly from the pandemic-related slowdown, and in 2022, the company experienced its best order performance for corporate jets in over a decade. General Dynamics' Combat Systems segment produces land-based vehicles such as the Abrams tank, the main battle tank of the U.S. Army since it entered service in the 1980s. We believe General Dynamics should continue to benefit from the incumbency advantage over its competitors in this large and stable market. The company's Marine Systems segment is one of only two major shipbuilders in the United States and enjoys one of the widest economic moats in the defense industry. The Technologies segment includes IT services and mission systems, the latter which provides mission-critical products for military applications. General Dynamics has committed itself to shareholder-friendly policies, highlighted by 25 consecutive years of dividend increases and the use of excess cash to buy back stock. The company has grown its dividend at a compound annual rate of 9.5% over the past 11 years, and management remains committed to continued dividend growth. In total, over the past 5 years, General Dynamics has returned nearly $12 billion to shareholders in the form of dividends and share repurchases. General Dynamics stock trades at 17.7 times estimated 2023 earnings per share, in line with both its historical range and industry averages. Given the current war in Ukraine and other geopolitical tensions, we believe defense spending globally should remain strong for the foreseeable future and support further earnings growth for General Dynamics. Gay and I have now completed our report on current economic and investment market conditions and two carefully selected investments we are currently purchasing in these uncertain times. We thank you for tuning into our report and wish you a healthy and financially successful 2023.